Ever pondered the best way to allocate your assets in your investment portfolio? A simple and effective guideline to consider is the 10-5-3 rule. Imagine your portfolio as a pie. The 10-5-3 rule suggests splitting this pie into segments of 10%, 5%, and 3%. The 10% slice? That's the portion you might consider dedicating to stocks or equities. These investments can be a bit riskier, but they often come with the promise of higher long-term returns. Think of this slice as the thrilling growth stocks in innovative and promising companies. Then we have the 5% slice. This portion could be allocated to bonds or fixed income. Bonds are typically less risky than stocks, but the potential returns are also smaller. Picture this slice as the dependable bonds issued by established governments or corporations, offering a consistent stream of income. And finally, the 3% slice. This could be set aside in savings accounts, also known as cash. While cash provides easy and quick access to your funds, its growth potential is usually minimal. Consider this slice as your emergency fund, ready for any unexpected expenses that might come your way. Remember, the 10-5-3 rule is more of a starting point than a rigid formula. Your risk tolerance and investment goals should be the primary drivers of your asset allocation. This guideline may be best suited to younger investors who have more time to ride out the market's ups and downs. And never forget the importance of diversification. Avoid putting all your eggs in one basket, and instead spread your investments across various asset classes to manage risk. And as always, consulting with a financial advisor is recommended. They can help you understand the nuances of different investment options and tailor a portfolio that aligns with your unique needs and goals. So there you have it. The 10-5-3 rule, a simple yet effective starting point for asset allocation in your investment portfolio, a sweet and simple recipe for your financial future.